Learners and viewers, today we will take MMPC 004 Accounting for Managers, Cost Accounting, Unit 6. Cost accounting. Initially, cost accounting was merely considered to be a technique of ascertainment of cost of products. Learners and viewers basis of historical data. In course of time, it was realized that due to competitive nature in the market, ascertainment of cost was not as important as controlling cost was. Hence, cost accounting is considered more technique for cost control than merely for cost ascertainment. Due to technological developments in all fields, cost reduction has now become most important than all these two. So, reducing cost, controlling cost, and ascertainment of the cost are the three functions. In general, cost means the amount of expenditure, actual or notional, incurred on or attributed to a thing. For example, if you have purchased a book for rupees 150, then it can be said the cost of the book to you is rupees 150. Similarly, if you want to purchase a furniture, then the cost of table wood rupees 500, then carpenter wages rupees 200 and 100 rupees for rent of work or transportation. Then it can be said that the cost of table is rupees 800. It may be noted, however, that the term cost cannot precisely define. Its interpretation depends on the nature of business or industry and the context to which it has been issued. The cost of elements are material. The substance from which the product is made is known as material. It may be raw material or a for a manufacture state. It can be direct as well as indirect material. All materials that become integral part of the finished goods can be conveniently assigned to specific physical units is termed as direct material. Some of the examples of direct material are all the material or components specifically purchased, produced, or requisitioned from stores. Then understanding and classifying the cost. Primary packaging material, cartoon, wrapping, cardboard board, boxes, partly produced or purchased components. These are the all direct material. Then indirect material, all materials that is used for purchase ancillary to the business which cannot be conveniently be assigned to specific physical units is termed as indirect material, such as consumable stores, oil and waste, printing and stationery material are the few examples of direct material cost. Then second is the labor. For conversion of this material into finished goods, human efforts are needed. Such human efforts is called labor. It can be direct as well as indirect. Direct labor takes an active and direct part in the production of a particular commodity, which is called direct labor. Its costs are therefore specifically and conveniently traceable to specific products. Indirect labor employed for the purpose of carrying but tasks incidental to the produced services provided are indirect labor. Such labors does not alter the construction, composition, and the condition of the cost accounting product. It can be practically traced to specific units. Wages of storekeeper, foreman, timekeepers, directors, fee, salaries of salesmen, etc. are the examples of indirect labor. There is a chart, cost, material, labor, expenses. Material direct, indirect, labor also direct, indirect, expenses also direct and indirect. Then overheads, factory overheads, office and administration overheads, selling and distribution overheads. All these three have indirect material, indirect labor, and indirect expenses. Now, direct expenses can be directly, conveniently, or wholly allocated to specific cost centers. cost units. Example of such expenses are hire of some special machinery required for a particular contract, cost of defective work incurred in connection with a particular job or contract. Indirect expenses are those that can be directly, conveniently, and wholly allocated to the cost centers. Cost units. Example of such expenses are rent, lighting, insurance, and charges. Overheads, including indirect material, indirect labor, indirect expenses. These indirect costs are overheads, as manufacturing organization can broadly be divided into three divisions: factory, then office, and selling expenses, selling office. Factory works where production is done, office and administration where the routine as well as policy matters are decided, and the selling and distributions where the products are sold and finally dispatched to the customers. Overheads may be incurred in factory, office, and selling and distribution division. Thus, the overheads may be divided into three. Factory overheads are indirect material used in the factory, such as lubricants, oil consumable stores, indirect labor, such as gatekeeper's salary, timekeeper's salary, manager's salary, indirect expenses such as factory rent, factory insurance, and factory lighting. Now, selling and distribution overheads, indirect material used such as packing material, printing and stationery material, indirect labor such as salaries, salesman, sales manager, indirect expenses such as rent, insurance, and advertising expenses. Now, components of total cost. Now, first is prime cost. It consists of the cost of direct material, direct labor, and direct expenses. It is also known as a basic or first or flat cost. Then factory cost, it comprises of prime cost, and in addition to this, the expenses incurred in the factory like works and factory overheads, which include cost of indirect material, direct material, indirect labor, indirect factory expenses. This cost is also known as works cost or production or manufacturing cost. Third is the office cost. It comprises of factory cost plus office and administrative expenses, overheads. It also termed as the cost of production. Now, third is the total cost. Fourth, it comprises of the cost of production and selling and distribution expenses. It is the total cost for the material. Cost accounting may be noted that some accountants do not use the term office cost at all. They prefer to use the term total cost after adding office and administrative overheads and selling and distribution expenses. However, while framing this chart, we have presumed that office and administrative overheads exclusively relate to the production. The selling and distribution overheads are inclusive of any office and administrative overheads that may be incurred in respect of sales. This is direct material, direct labor, and direct expenses. This is prime cost. Then prime cost plus work overhead, work of factory, cost production, cost management. Then work cost plus administrative expenses. This is the total cost of production. Office cost plus selling expenses, the cost of sales. This is the total cost. This is a chart of all these costs which I have explained. Now, another is the cost sheet in which we can prepare that what is the cost classified under prime, what is the factory cost, and what is this total cost. Now, classification cost is broadly classified into fixed, variable, and semi-variable and step costs. There are four types of classification. Fixed costs are those which remain constant irrespective of the quantum of output within and up to the capacity that has been built up. Examples of such costs are rent, insurance charges, management salary, purchase of land and building. Then fixed cost remains constant as per unit time. As a result, they decrease per unit of every increase of output, vice versa. For example, if rupees 6,000 have been paid as rent for factory building output of 1,000 units, the cost per unit will be rupees 6. In case the output increases to 1,200 units, the cost of rent of the unit will decrease to rupees 5. In case of the output reduced to 800 units, then this cost will increase to 7.5 rupees per unit. Fixed costs sometimes are also referred to as the period cost. They can further be divided into committed fixed and discretionary fixed cost. Committed fixed costs consist primarily of those fixed costs that arise from the possession of the plant equipment and basic organizational structure. For example, once a building is constructed and the plant is installed, nothing much can be done to reduce the cost, such as depreciation, property taxes, insurance, salaries, and the key personnel, without repairing in the organization's competence to meet the long-term goals. Discretionary fixed costs are those which are set at a fixed amount for a specific time period by the management in the budgeting process. These costs directly reflect top management policies and have no particular relationship with the volume of output. These costs can therefore be reduced or eliminated if the circumstances so require. Examples of such costs are research and development costs, advertising and sales promotion costs, donations, management consulting fees, etc. These costs are also termed as managed or programmed costs. Variable costs vary in direct proportion to the output. They decrease or increase in same proportion in which the output increases or decreases. The example of such costs are direct material, direct labor, power. Variable costs may be said to be constant per unit of output. For example, if a factory incurs rupees 1000 on raw material for an output of 1000 units, the cost of raw material per unit will be rupees 1. If the output increases to 2000 units, the cost of raw material would proportionately increase to 2000 rupees 1 multiplied by 2000. Similarly, if the output decreases to 800 units, the cost of raw material would also decrease to rupees 800, 1 multiplied by 800. Variable costs are also referred to as product cost. Figure 62 gives the graphical presentation. Graphical presentation is not there. Semi-variable costs, there are the costs that do vary but not in direct proportion to the output. They are made up of both fixed and variable cost elements such as depreciation, repair, light, heat, telephone. Semi-variable costs are shown graphically, figure of that graph is note there. Identification of fixed and variable elements and semi-variable costs is essential for management of planning their business activities. Different methods are available for the purpose, which will be discussed. Stack cost, fixed cost in general remain fixed over a range of production activity and then jump to a new level as activity changes. For example, if a foreman can supervise a given number of workers, beyond this number, it is necessary to hire a second foreman, then the third, and so on. Similarly, the rental cost of delivery vehicle also follows the same pattern. Direct cost that can be directly, conveniently, and wholly traced to a product, service, or job. Example of such cost: direct material, direct labor, and direct expenses. Indirect costs, these are the costs cannot be directly or conveniently and wholly identified with a specific product, service, or job. They include all overhead costs such as salaries of timekeeper, storekeeper, foreman, printing, and stationery cost. Indirect overhead costs are apportioned to different jobs, product, services on a reasonable basis. For example, the indirect factory labor cost may be apportioned over different jobs according to their direct labor cost. Similarly, the selling overheads can be charged to different products according to their sales value. Some other concepts of cost are shutdown cost and sunk cost. These represents the fixed costs that have to be incurred even when the factory is shut down on account of some temporary difficulties. For example, shortage of raw material, non-availability of requisite labor force during the period, though the work is not done, no work is done. The fixed costs such as rent, insurance, depreciation, maintenance, for the entire plant are still to be incurred. Such costs of the ideal plant are also known as shutdown cost. Sunk cost, these are historical or past cost. These costs incurred as a result of a decision made in the past. Such cost cannot be reversed or revised by subsequent decisions. Investments in plant and machinery building are some prominent examples of such costs. Some costs are considered not relevant for decision concerning the increase in the present profit level. Now, controllable and uncontrollable costs. These are the costs that can be influenced by the action of the specified member of the organization. For example, if the foreman of a production department can control the utilization of power, raw material in each department, these are therefore controllable costs as far as he is concerned. Uncontrollable costs are those which cannot be influenced by the action of the specified member of an undertaking. For example, the foreman of a production department cannot control the wastage of power at powerhouse, but he can control the wastage of power in his department, resulting in a higher cost per unit of the power to him from powerhouse. Similarly, he cannot control the increase in the cost of material consumed in each department if the purchasing department or the supplying department buys the material at higher prices due to its own inefficiency. Such costs are controllable at the particular level of management while they are uncontrollable at some other level of management. The difference between the controllable and the controllable cost is of particular significance to the management. The executive concerned should be held responsible only for those costs which are within his control and not far from beyond his control. Imputed or hypothetical cost. These are the costs that do not involve cash outlay. They are included in cost account but are important for making management decisions. For example, interest on capital is ignored in cost accounting. However, it is considered in financial accounting. If the two projects require unequal outlays of cash, the management must take into consideration interest on capital to judge the relative profitability of the projects. Differential incremental and discremental costs. The differential is total cost between the two alternatives is termed as differential cost. In case the choice of alternative result is an increase in the total cost, such increased costs are known as incremental cost. If the choices decreases total cost, then resulting the decrease in the cost is called as decremental cost. While assessing the profitability of the proposed change, the incremental costs are matched with incremental revenues. Out-of-pocket cost means the present or the future cash expenditure regarding a certain decision, which may vary depending upon the nature of the decision made. For example, a company has its own trucks and transporting raw material and finished products from one place to another. It seeks to replace these trucks by employing public carrier departments. In making this decision, of course, the depreciation of the trucks is not to be considered. However, the management must take into account the present expenditure on fuel, salary of drivers and maintenance, which have to be incurred in cash. Such costs are arriving at the decision are termed as out-of-pocket cost. Now, opportunity cost refers to the advantage in measurable terms which has been foregone on account of not using that facilities in the manner originally planned. For example, suppose an old building is proposed to be utilized for housing of a new project plant. In that case, this is likely the revenue that a building could have fetched if rented out is the opportunity cost that should have been considered while evaluating the profitability of the project. Suppose you have a sizable deposit in the bank fetching a return of 10% per annum. When you deposit in early maturity, that can be your friend approaches you with a business proposal that it is likely to earn you a return of 18% after tax. After careful consideration of the factor Relating to risk and return, you decided to go for the proposal. Obviously, you have to give a tip to the existing alternative in view of the limited funds you have. Thus, you will no longer to have the bank deposit, and this sacrifice in this term is 10% interest on your deposit in the bank that you have to forego if you go in for the business proposal, and this is the opportunity cost for your new alternative. Now, traceable, untraceable, and joint costs. Traceable costs that can be easily identified or traced to specific product, services, and unit of the company, such as raw material and labor. Untraceable costs are those which cannot be identified with a department, process, or product. Such costs are also termed as common cost as they are incurred collectively for a number of products or cost center. Overheads incurred in the factory as a whole. Joint costs are those costs for two or more products are produced out of the same raw material or process. The cost of material purchased and the processing costs are called joint costs. Take the example of an oil refinery where a range of products such as bitumen, petrol, kerosene, diesel are derived in the process of refining crude oil. All these products have joint costs comprising of cost of crude and the cost incurred in the course of refining. The joint costs are the apportioned to various products on the same basis. Conversion cost, the cost of transforming direct material into finished goods. Exclusive of direct material cost is known as conversion cost. It is usually taken as aggregate of the cost of direct labor, direct expenses, and factory overheads. Now, Unit 7, absorption of marginal costing. The cost of a product or a process can be ascertained using the different elements of the cost by the following techniques of absorption costing. One is marginal costing. Absorption costing, also termed as traditional or full cost method. The cost of product is determined after considering both fixed and variable cost. The variable costs, such as those of direct material, direct labor, are directly charged to the product, while the fixed costs are apportioned on a single suitable basis over different products manufactured during a period. Thus, in case of absorption costing, all the costs are identified with the manufactured product. This is a table. Tripura Limited manufacturing three products A, B, and C. Cost of manufacturing as or direct material for A, B, and C rupees 3, 4, and 5 respectively. Direct labor rupees 2, 3, and 4. Selling price 10, 15, and 20. Unit will be produced 1,000 by each product. These total overheads are 12,000, out of which 9,000 are fixed, and the rest 3,000 are variable. It is decided to apportion these costs over different products into ratio of output. We will prepare a statement showing the cost of such profits in absorption costing. Now you see the chart. The total cost of fixed and variable in product A is 9,000, then B 11,000, and C 13,000. The selling price of product A is 10 multiplied by 1,000, 10,000, then 15,000 for B and 20,000 for C. Now, after deducting the total cost from the selling price, the profit in case of A product is rupees 1,000, 4,000 in B, and 7,000 in C. So the total profit of the three products is 12,000. This system costing has some disadvantages. It assumes price are simply a function of cost. It does not make account of demand. It includes past cost, which may not be relevant to the pricing decision at hand. It does not provide information that aid decision making is rapidly changing market environment. Now, this is the profit and loss. Direct material A 3,000, B 4,000, C 5,000, total 12,000. Direct labor A 2,000, B 3,000, C 4,000, total 9,000. Overheads 1000 is 3000, fixed cost 9,000. So total, this is 12,000 and total cost is 33,000. Sale of stock, opening stock 30,000, 33,000 of first year. Then second year fixed overhead 9,000. Profit is 3,000. Total 45,000. Sales a this. So this is the sale in the second year is 45,000. In this case, the first year profit, there is no profit because there is no sale. In 2 years, the profit is only 3,000. So this is another example. Statement of profit, sales 800 and 200, total 1,000. Sales 80,000, 800 multiplied by 100, 200 multiplied by 60, 12,000, total 92,000. Total cost fixed 24,000. Then profit 24,000 in second, 4,000, total 28,000. Marginal costing. The Institute of Cost and Management Accountants, London, has defined marginal cost as the amount at any given volume of output by which aggregate costs are changed if the volume of output is changed by 1 unit. On analysis this definition, we can conclude that the term marginal cost refers to an increase or decrease in the amount of cost on the basis of increase or decrease of production of a single unit. The unit may be single article or a batch or similar article. So this is an example of marginal costing, product A, product B and C. Direct material, product A rupees 333,000, direct labor 2,000, variable overhead 1,000. So total marginal cost for 1,000 unit is 6,000 rupees. Then selling price for 10 per unit is 10,000. So after deducting this marginal cost, the contribution is 4,000. Similarly, in product B, the contribution after deducting 8,000 from 15,000 is 7,000. And in product C, the contribution is 10,000. So the total contribution from these three products is A, B, C are 21,000. 10,000 plus 7,000 plus 4,000. The profit will now be computed as follows. Contribution 21,000, fixed cost 9,000, the profit is 12,000. The marginal costing helps thus the manager taking decision, as can be seen from this illustration. Direct labor 2,000, for B 3,000 and C for 4,000, total 9,000. So this is 33,000. Profit and loss of second year 45,000 minus 33,000 is 12,000. Absorption costing differences, recovery of overheads, valuation of stocks and absorption of marginal costing. Now, taking the figure sign 1, let us compute the amount of profit under the margin and traditional costing system if units sold of product ABC are 900 each. Now, the marginal cost of product A is 6,000, B 8,000 and C 10,000. Fixed overheads are 3,000 for each. Total cost of production is 900, B 1,100 and C 1,300. the less closing stock in A 900, B 1100, and C 1300. So thus the total profit under absorption costing is cost of goods sold 8100 minus sales 9000, profit is 900. In B it is 3600, in C it is 6300. So the total profit of ABC is 10800. The marginal cost, A product 6000, less stock 600, goods sold 5400, the contribution is 3600. In case of B, it is 6300 and C is 9000. So the total profit in case of marginal costing is 3600 plus 6300 plus 9000, total 18900. Fixed cost is 9000. So total profit is 9900. Now segregation of semi-variable cost. As explained earlier, marginal cost method requires the segregation of all costs into two parts, fixed and variable cost. This means that the semi-variable costs will have to be segregated into fixed and variable elements. This may be done using any of the following methods: level of output compared with level of expenses methods, high-low methods, degree of variability methods, scattered graph method, and least square method. Contribution. The contribution is selling price minus variable cost or marginal cost is equal to fixed cost plus profit. From the above, we can conclude that profit cannot result unless contribution exceeds the fixed cost. In other words, the point of no profit or no loss will be at a level where the contribution is equal to fixed cost. Now, break-even analysis. The term break-even analysis refers to as the system of determination of that level of activity where the total cost equals the total selling price. However, in the broader sense, it refers to the system of analysis that determines the probable profit at any level of activity. The relationship between cost of production, volume of production, profit and sales value is established by break-even analysis. The analysis is also known as cost volume profit analysis. Break-even analysis is helpful for a manager in the following ways. It helps him in forecasting the profit reasonably accurately. It helps set up flexible budgets based on cost volume. The break-even point can be calculated. Fixed asset divided by contribution, or fixed asset divided by PV ratio. The PV ratio is 1 minus variable cost divided by selling price per unit. Utility of marginal costing. The technique marginal costing is immense use for the management in taking various decisions as explained below. It helps in determining the volume of production. Marginal costing helps in determining the level of output which is most profitable for a running concern. The production capacity therefore can be utilized to the maximum possible extent. It helps determine the most profitable relationship between cost, price and volume in the business, which helps the management to fix the best selling price for the product. Thus, maximization of profit can be achieved. The limitation of marginal costing. It is tough to analyze cost under fixed and variable elements. The nature of cost in several cases may not be very clear. Moreover, some items of cost may be partly fixed and partly variable. Splitting such cost into fixed and variable components may have to be based on assumptions. Besides, some overheads may have no relation either to the volume of output or with the time factor. As such, they cannot logically be categorized either as fixed or variable. The management decisions regarding bonuses to workers, facilities to administrative staff are some of such examples. The difficult application marginal costing techniques is challenging to apply in many firms. Its scope is highly circumscribed where job posting is the need. Notwithstanding the limitations mentioned above, marginal costing, it is regarded as an advantage technique for analyzing several business decisions. Eighth unit, activity-based costing. ABC is the tactic to costing and does monitoring of activities in process. It traces the consumption of resources and then the costing of resultant output. In this, resources are assigned to activities and then activities to cost object based on consumption estimates. It utilizes identified cost drivers to assign activity cost to depicted outputs. Another description of activity-based costing is that it is a two-stage based costing method that allocates indirect cost and overheads to products and services. Some costs are tough to assign to a project or a service. Identifies the connection between the overhead and the manufactured products and gives indirect cost to the products. The method is less arbitrary than the traditional costing system. ABC's modern approach to the allocation of indirect cost allocated to each activity symbolizes the resources consumed by that activity. As done in conventional costing, ABC is not restricted to the allocation of indirect cost to departments. It moves further to identify the individual activities of indirect cost allocation as the lowest unit. Based on consumption, resources are allotted to each activity and then to cost object. ABC identifies the activities using the activity cost drivers and result in more accurate cost calculation. This approach facilitates each identification of cost according to activities cost driver. This costing method is suitable if there is more than one product in the manufacturing line and overheads have a high share in total cost. This approach creates a straight cause and effect association with various resources. Development of activity-based costing. As the business grows, the cost become more complex and then the traditional approach may not be appropriate for making complex decisions related to production and developing product strategies. The traditional method facilitates financial reporting and primarily put prominence on calculating overhead rates for the valuation of stocks. It was seen that the traditional absorption costing approach could not be well with multi-product scenarios. So a change was in line. In fact, multiple product scenario or product diversification requires accurate product cost ascertainment due to increasing market competition within the country and internationally. In 80s, ABC was first defined by Kalpan and Burns. Two, it was taken as modern alternative to absorption costing, which could define product and profitability in a better way. It provides better information to make more effective decisions. This is one chart how the traditional costing and the ABC allocation method cost directly related to product. Here the cost, then activity, then product. The difference between activity-based costing and traditional costing is one, it allows overheads on the basis of various cost pools of activities, while in traditional costing, it assigns overhead based on a single overhead rate. Second, favorable for technology-driven manufacturing process. In traditional costing, it is favorable for labor-driven manufacturing process. Third, the favorable when the overhead increase is based on various activities that different for various products. It is favorable when the overhead increases are based on traditional component. Importance of activity-based costing. One, the decision making is one of the significant functions performed by the managers. Multiple cost drivers are used in ABC that are transaction based than the product based. ABC follows all activities even outside the factory premises to calculate more overheads. ABC focuses on the cause and effect relationship in costing. This is to bring accuracy and reliability in cost determination. Due to ABC, cost as per activities become visible and more apparent. It can identify actions not adding value of products. Then objectives of activity-based costing. Some objectives of ABC are as under: one, to recognize several activities in the process of production, including the activities that own value; to eliminate the non-value adding activities; to put emphasis on the high-cost activities; to incorporate activities based on distribution overheads; to help in decision-making process in the identification of a suitable price of product and services; to ensure accurate and precise cost determination of product and services; to find options to improve the process and reduction of the cost. Merit and demerits of this system. Now the merits: it removes the cross-subsidization issues. It deals with the complicated processes. The products customizations, identification of cost saving chances. Demerits are a complex system and the products and process should be fully known. Now the process activity based on the stages. Stages of costing: stage 1, tracing the cost of activities; stage 2 is the tracing activities of the product; then step 1, identification of the organization activities and manufacturing process; step 2 is classify the factors which determine the cost of an activity, known as the cost drivers; step 3 is identify the cost of each activity, known as the cost pools; step 4 is the charge cost to the product. Now, level of activity: one is unit-based activity, performed when each time unit is produced. Second is the batch-based activity, performed each time when the batch of products is produced. Third is production-based activities, performed each time different products are performed. In the factory-based activities, performed to sustain a factory manufacturing process. Now, these are the cost drivers. Various cost drivers at different levels, as mentioned above, are cost driver: production order received, purchase order, order received in other department, order processed, number of units produced, labor cost incurred, material used in a product, material handling hours, factory management, inspections, machine hours used, setup hours, direct labor hours, vendors numbers, unit scrapped, employees, maintenance, testing charges, security, and others. Now, this is a live example. Suraj Enterprises have decided to use activity-based method for the following activities: machine 40 hours, cost 10 lakhs; driver 600 hours; then labor 6 lakhs, cost 60,000; cost of driver is 14,000; setup 20,000 hours, cost 2 lakhs, driver 150 hours; production order 4,000 orders, cost 4 lakh rupees, cost 10 orders; material handling 2,000 requisitions, cost 40,000 requisitions; then part administration 24,000 parts, cost 9 lakh 60,000; driver 40 parts. All factory overheads cost to product are based on 300% of direct labor cost. Now, compare the total annual cost of the product using both the traditional and ABC method. Solution: cost system. Traditional cost system, pool rate 300%, cost driver consumption rupees 14,000, cost assignment multiplied 14,000 by 300%, it is 42,000. Now, in ABC system, labor 10%. 10% of 14,000 is 1,400. Machine 25 per hour unit, used for 600 hours, 15,000. Setup rupees 10 per hour, 150 hours, total cost rupees 1,500. Production order, 100 per order, 10 orders, rupees 1000. Material handling charges, rupees 20. Pull rate, 6 revision, total rupees 120. Parts, rupees 40 per part, 40 parts, total cost 1600. So the total of this under AB system, total cost is 20,600. The total cost of product under ABC is 24,620, whereas under the traditional, this is under traditional cost system, it is 42,000. So there is a profit of around 20,000 in the ABC system. Now this is another example. XYZ limited calculated activity cost based on driver capacity, quality inspection, power, kilowatt hours, capacity 12,000 inspections, 50,000 kilowatt, total cost 4,80,000, and for power 2,50,000. The company has three products XYZ. The following drivers were reported at the year end of 31st March 21. XYZ kilowatt 11,000, 19,000, and 16,000. Quality inspection 3,200, 2,400, 2,900. Calculate the cost allocated. Compute the cost of unused capacity of each activity too. The cost allocated are X 55,000 multi 11,000 kilowatt multiplied. Then the quality 1,28,000, 32 3,200 multiplied by 40. Then in case of Y, the power 95,000, 19,000 multiplied. Then in quality 96,000, 24,000 multiplied by 40. In Z, 80,000, 16,000 kilowatt. Then quality 1,16,000, 2,900 multiplied by 40. So the total cost of quality is 3,40,000, while the power 2,30,000. Cost of unused capacity of each power quality rupees 20,000, 2,50,000 minus 2,30,000, which was already given. Then 1,40,000, 4,80,000 minus 3,40,000. So the total cost of unused capacity is 1,60,000. Working notes, rate unit driver, power 2,50,000 divided by 50,000. This is rupees 5 per kilowatt. Similarly, quality inspection 4,80,000 divided by 12,000 inspection, rupees 40 for inspection. The data dealing to Sundar. This is another example. Now we few other terms. Activity-based management, similarities. Both ABC and ABM help in managing business activities and improving the performance of an organization. Difference. The ABC relates to the cost measurement and the presentation of the various activities. It relates to cost drivers of two activities, but the ABM put emphasis on the activities as a way for refining the value obtained, as it identifies several activities and processes that customer need and pay for. The ABC may be called a subsection of ABM. It helps refine the costing by outlining the numbers, expenses like salaries, rent to activities. The activity-based system and Kaizen costing system. Point, scope of costing. ABC, this is the inside system. KC is the outside the system. Time in view is long term. The view is short term. Main focus is on fixed cost, while in KC the main focus is on variable cost. The relationship with costing is direct, that is indirect. Usage cost drivers plus performance measures. Here in KC it is only performance measure. The activity-based budgeting ABB is dissimilar from traditional budgeting, as it makes available a relation amid the aim of an organization and the specific activity. Traditional budgeting is built on a traditional costing system based on allocation, apportionment, and absorption of overheads. ABB needs to identify various activity of the business, identify the element that create cost and their drivers. Then the cost pool are created to collect the cost of the activities. ABB involves classification of the activities and allocating them into value adding and non-value adding activities. In due course, the non-value adding activities are removed. Features of ABB are as follows. It relates to cost to activities. Further, it identifies opportunities for cost improvement. Activity step 1, class high activity, analyzing client applications, customer meetings, creating credit reports, etc. Step 2, allocate cost to the identified activities, salary of staff, analyzing and reviewing applications, cost of technology involved, supplies needed. Step 3 and step 4 are estimated overheads portion for identified activity, except 5 is a portion overheads to products. This is the illustration of activity cost drivers, activity and cost driver, consolation of clients, meeting time, maybe hours, analyzing customer application, number of application analyzed, creating credit reports, number of credit reports created. Now limitations activity-based costing are ABC requires ample investment of money and time and need trained professionals. A small organization may not have these. ABC further requires support from top management, otherwise the process cannot be completed effectively. ABC being a bit complex requires the compilation of a number of reports and complex calculations. As mentioned earlier also, it may be suitable for large organizations, but traditional cost accounting may be more favorable for smaller one due to its simplicity. Cost determination may not be easy as single cost supports several activities. Now, this is profit graph. Cost segregation into dominant group with fixed and variable cost remains variant volume activity that would be considered fixed. No cost are fixed. Costs that vary in direct proportion to the volume activity will be classified as variable cost. Costs that otherwise belong to mixed category, which neither belong neatly to category A or B above, would in fact be apportioned to one of the two categories, fixed or variable. Now, the another unit is 10.2 budgeting and budgetary control. Unit 10. A budget is an essential tool for financial planning and control. The financial planning is concerned with the raising of funds and their effective utilization to maximize the company's wealth. It includes the determination of the amount of funds needed for implementing various business plans, the pattern of financing, this form and proportion of various corporate securities such as shares, debentures, bond, bank loan to be issued, raised. The timing of rotation of various corporate securities. What is a budget? A budget is a plan expressed in qualitative, quantitative, usually monetary terms, covering a specific period of time, usually 1 year. In other words, a budget is a systematic plan for the utilization of workforce and material resources. In a business organization, a budget represents an estimate of future costs and revenues. Budgets may be divided into two basic classes, capital budget and operating budgets. Capital budgets are directed towards proposed expenditure on new projects and often require special financing. The operating budgets are directed towards achieving short-term operations goals and of the organization. For instance, production or profit goals in a business firm. Operating budget may be subdivided into various departments. Functional budgets. The main characteristics of a budget are it is prepared in advance and is derived from the long-term strategy of the organization. It relates to the future period for which objective of the goal have already been set up. It is expressed a quantitative form, physical and monetary units, or both. The budgetary control, no system of planning can be successful without having an effective and efficient system of control. Budget is closely connected with control. The exercise of control in organization with the help of budget is known as budgetary control. The process of budgetary control includes preparation of various budgets, continuous comparison of actual performance and budgetary performance, revision of the budgets in the light of changed circumstances. Installing a budgetary control system, having understood the meaning of the significance of budgetary control is an organization, it will be useful to know how a budgetary control system can be installed. This requires first of all finding of answers to the following questions. One is what is likely to happen, what can be made to happen, and what are the objectives of the to be achieved, what are the constraints, and the what extent of their efforts can be minimized. Organization for budgeting, responsibility of budgeting, budget control or budget committee, fixation of the budget period, budget procedure, key factor, marketing, making a forecast, preparing budgets, choice between fixed and flexible budgets. This is the classification of budget can be classified into direct, different categories of the basis of time, function, and flexibility. The different budgets covered under each category are shown in this chart. The time, long term, time, short time, current and rolling, functions, sales, production, cost of production, purchase, personnel, research, capital expenditure, cash and master, then flexibility, fixed and flexible. The rolling budget, sales budget, production budget, direct labor budget, overhead budget, factory overhead budget, administrative overhead budget, selling and distribution overhead budgets, cash budget, sales worksheet, purchase budget, master budget, fixed and flexible budget, and fixed budget. The organizational factor and the environmental factor. Past sales figures and trained salesmen estimates, plant capacity, orders on hand, proposed expansion of discontinuation of products, availability of material, suppliers, financial aspect, cost of distribution of goods. Then environmental factors are general trade prospects, general fluctuations, potential market degree of competition, government controls, rules and regulations relating to industry, political situations, and its impact on the market. This is the performa of budget, then control ratio, activity ratio, capacity and efficiency ratio. The activity ratio is measure of the level of activity attained over a period of time. It is optional, obtained by expressing the number of standards hours equivalent to the work produced as percentage of the budget hours. Capacity to this ratio indicates whether and to what extent budgeted hours of the activity are actually utilized, shows the relationship between the actual number of working hours and the maximum possible number of working hours in a budgeted period. Efficiency ratio, this ratio indicates the degree of efficiency attained in production. It is obtained by expressing the standard hours equivalent to the work produced as a percentage of the actual hours spent in the working of the work. The performance budgeting, the main objective of the PB are to coordinate the physical and the financial aspects to improve the budget information, review and decision making at all levels of management, to facilitate better appreciation and review of controlling authorities, legislature, board of trustees and governors, etc. as the presentation is more purposeful and intelligible, to make more effective in performance audit possible, to measure progress towards long-term objectives which are envisaged in a development plan. The zero-based budgeting process of zero-based budgeting is the following steps that are involved in zero budgeting is determining the objective of the budgeting. The objective may be to effect cost reduction in staff overheads, or it may be to drop after careful analysis projects which do not fit into the achievement of the organization's objectives. Deciding on step application, the extent of which zero budget base must be introduced has to be decided whether it will be introduced in all the areas of the organization activities or only a few selected areas on a trial basis. Developing decision units, cost of benefit analysis and proposed have to be developed so as to arrive at decisions whether they should be allowed or continued to be dropped. Each decision unit as far as possible should be independent to other units so that it can be dropped if the cost analysis proves to be unfavorable. Now, developing decision makers, it is necessary to patent particular activities at all. Answer is negative, then there is no need to proceed further. After completing decision package of each unit, the units are ranked according to the findings of the cost-benefit analysis. Essential projects are identified giving the highest ranks. नमस्कार, थैंक यू। एक मिनट है अभी, एक मिनट है, मेरा हो सकता है, चलो।